Welcome to our deep dive into how we measure the risk of a country defaulting on its debt. Today we are comparing three critical tools: credit ratings, default spreads, and CD spreads. To understand sovereign default risk, we first look at credit ratings. These are expert opinions provided by agencies like Moody's or S&P. Think of these as a long-term anchor for investors. However, ratings are known as lagging indicators because they change slowly and often wait for official data before moving, which means they might miss sudden shifts in the market. They also tend to group many countries into broad categories like Bar 2, even if some of those countries are slightly riskier than others. If we want something more immediate, we look at the sovereign default spread. This is a market-based measure representing the extra interest a country must pay compared to a risk-free benchmark, like a US Treasury bond. The formula is simple: the sovereign default spread equals the yield on the risky country bond minus the yield on the risk-free bond. Because bonds trade constantly, these spreads provide real-time data and act as leading indicators, often widening significantly before a rating agency actually issues a downgrade. The downside is that they can be noisy. Spreads might move because of general market panic or low trading volume rather than a change in the country's actual credit health. Finally, we have CD spreads, which come from the credit default swap market. A CDS is essentially an insurance policy against a bond default, and the spread is the annual fee you pay for that protection. Many consider this the purest measure of risk because it focuses specifically on the cost of insurance. CD spreads are incredibly sensitive and often react even faster than bond spreads to political or economic news. In fact, changes in the CDS market often pull bond yields and credit ratings along with them. While powerful, the CDS market can be small and illiquid, and because the spread factors in market and liquidity risks, it can sometimes overestimate the actual risk of default.